Should you insure your rental property against death and disability, critical illness? And is it a tax deduction? What should you be thinking about when it comes to your revenue properties? Here's 3 key things to think about. When you go get lending from the bank or a mortgage broker, they're going to ask if you would like to insure the mortgage against death, disability, critical illness. And a lot of times people will just add it on without really thinking it through. So here's what you should be thinking about. First of all, the premium is not a tax deduction. So I just came across during tax filing somebody that was including the premium on the rental property as a tax deduction. This is not a deduction. So the $847 premium per year for this life insurance, you got to think about the pre-tax amount. So this is costing this person over $1,200 per year pre-tax in order to pay this premium. So secondly, if the revenue property is already self-sufficient, why do we need to protect it against death and disability? If the owner of the property is alive or deceased and the property still pays for itself, why would we need insurance? I'd really want you to think about the need in the event of one of the owners passing. Does it really need to even be insured? And lastly, what's the opportunity cost? So on an annual premium of $847, what else could you be doing with that money if the property is already self-sufficient? Think about what the interest savings would be if you just put that as an extra payment on your rental property principal mortgage, or maybe you saved it in your RRSP, got the tax refund, and then put it down on the principal mortgage. So those are the key things that I think that you should be thinking about when insuring your rental property. I always want to recommend you be properly insured for you and your family, but reconsider the benefits and the costs when insuring a rental or revenue property.